You're listening to The Real Well Show with Kathy Fettke, the real estate investor's resource.
Welcome to The Real Well Show. I'm Kathy Fettke, and I've got Rich Fettke here with me today.
Good to be here.
My husband and co-CEO. And today we are going to be doing another Real Wealth story, interviewing somebody you met at CG.
Yeah, Mike Zlotnik, or Big Mike, is when I met him. I was introduced to him as Big Mike, or the Big Russian. And I was very impressed with his analytical skills, the way he thinks. And then Kathy and I actually had him underwrite one of our projects to really take a look and a deep dive into it. And he gave us some really good advice and input on that. So
we're excited to have him here on the Real Wealth Show to see how he got started, to hear a little bit about his life in Russia before, and we asked some personal questions about that. So we're excited to share this interview with you. So Mike, welcome to the Real Wealth Show.
Thank you, Kathy. Thank you, Rich. Appreciate you inviting me.
Yeah, good to see you again.
Yeah, so we would
great to see you too, guys.
Yeah, it's been a year of not seeing too many people.
I know. Yeah, miss those in-person meetings. Yeah.
So we would love to hear about how you got started in real estate and when that was.
Sure. So we met through the Collective Genius in person a few years back, but been doing real estate sort of part-time since 2000 and full-time since 2009. My story is fairly simple, straightforward. So I grew up in the former Soviet Union. It was Soviet Union when I left. So I was a political refugee from the communist evil empire. And I kind of ran away in 2009. I don't want to give them the whole story, but they killed off my father. My mother and I were political refugees. We arrived in the United States in '89. So we are U.S. citizens and U.S. patriots. But I started my career like most kind of graduates from the former Soviet Union with engineering and mathematics. I'm a mathematician by education. So I actually went to school here in the United States, got a degree in mathematics from Binghamton, New York. And this is what I actually love, math, computer science. This is where I started. Okay. And then I spent almost 15 years since 95 till 2009 in software, starting from rank and file and going all the way through executive number of companies. And while I was doing this, I started to invest in real estate. So 2000, I bought my first apartment in New York City. So it's kind of my first home.
And how many units was that first apartment?
It was 2-bedroom apartment in Brooklyn, New York.
Okay.
Oh, so you bought one unit for yourself?
Yeah, I bought one unit for myself.
I see.
And then I bought a package in the same building. Off the top of my head, it was 88 units. And then I kept buying more apartments. And then I bought a multifamily house in Brooklyn, New York. And I came to a basic conclusion that at least observing what's been happening, everything I seem to appreciate, everything close to the subway was appreciating at about 10% a year. Strange observation, but proximity to transportation was 10% a year on average. And if it was away from the subway, it appreciated a whole lot slower. So there's something to that pretty straightforward logic. And then I just kept buying apartments, and then I stopped because everything became too expensive. Just you couldn't get the cash flow. The sad part, unless you're getting a bargain price, you would have to put down 20-25%, get a mortgage, and you barely break even. That's New York City. You don't make any money. You only make money on appreciation. Right. Now, it works when you borrow money from the Fannie Freddie at 4.5-5%, and it appreciates at 10% a year. It's a no-brainer. That's, by the way, a golden rule of investing. If the rate of appreciation on your property is higher than the rate on the mortgage, you will wind up ahead.
You guys, big number math. I like that. Simple.
Very simple, but you have a lot of single-family residential investors. I mean, this is your expertise, and you could use the same technique everywhere. Wherever you go, any part of the country, if the average historic appreciation is 6% and your rate in the mortgage is 4%, you can't lose.
But back then, it wasn't that low, was it?
It was 6%. So a lot of the properties, I remember the rates were on 6%.
Right.
Appreciation was 10%. Couldn't go wrong.
Well, how did you come up with the down payment?
Career in software. I was making pretty good pay as software executive, saving money, investing, stock market. So most of my initial capital came from sort of saving and investment, and then
And pulling it out of the stock market and using the.
yes.
Okay.
Got it.
Now, were you married and with children at the time? Because sometimes when you live in a high-priced market like New York City and you've got a family, it's hard to save money. I mean, how did you do that?
It is absolutely true. I've been happily married to my lovely wife at this
Mhm.
point for over 21 years. We have 4 kids and a cat, the 5th child. So
Nice.
it's kind of interesting you said that. Yes, it is expensive. Kids cost a lot of money, but I did okay in software, and I was able to invest well and kind of reinvest in real estate. And then you have compounding effect when you buy with leverage and you get cheap Fannie Freddie money, and everything is appreciating. Your compounded rate of return, you know the basic math. So if your apartment appreciating at 10% and you have 75% leverage, your effective rate of return is in the high teens. So
Mm-hmm. Yeah.
it's not more.
So did you self-manage when you started out, when you were buying those apartment units?
Well, that's the easy part about apartment units in the buildings, and the building has super. You give super a Christmas gift, and you bring him the good old Russian souvenir called hard currency bottle of vodka. And,
Smart.
Oh, we've never done that.
No.
it actually, you build a relationship with the super. They take care of any issues. You don't need to. At least I didn't need to have professional management company.
That's genius.
Just having the right. When you say super, what do you?
Superintendent. I mean, superintendent in the building, they manage any problems, and tenants just pay. The one technique I've used for years, I've kept the rent below the market, and people never leave. My tenants in number of my apartments, I've had them, I want to say almost since the beginning of time. They never left, or it's been a long time since I bought those apartments, and they don't leave if the rent is below the market.
A little below market is what you said?
Yeah. So how much? 10% below the market, sometimes 15% below the market.
Interesting.
They won't leave you. It is theoretically, the way I think about this is the cash flow from these apartments is relatively small. It's New York City. I mean, but appreciation is substantial. I want these apartments to be taken care of. I don't want to worry about it. Whatever I'm foregoing in the cash flow, it makes my life a whole lot easier. They pay on time. They don't cause me any grief. So it because it's a highly appreciating market. I want a good relationship with tenants, and I want them to feel that they have a price better than if they went somewhere else.
So a long-term play.
Yeah.
It's a long-term play, exactly.
So, yeah, I usually hear the opposite. People always trying to push rents whenever they can.
Right. Or it's amazing too. We've heard people, it's like their property goes vacant for a couple months and they're just not willing to go below market rate. They're like, nope, they get so stuck on one rate. And then, they give up 2 or 3 months of rent. And it's like, they could have just, solved the problem in 2 weeks.
Yeah. They'd rather vacant if they can't get the rent they want than lowering it.
Yeah.
Doesn't make sense.
Exactly. My observation is very simple. The cost of return and the cost of vacancy is far greater than keeping the rent a little below the market. And you can argue for going a little cash flow, but most of the return in New York City comes from appreciation, not the cash flow.
Right.
So let's use an example. Say my rate of return with market rate could have been, let's use an example, 15%, 10 coming from the appreciation and 5 coming from cash flow. And New York City is not 5 cap, it's lower than that, but I'm just using this as an example. Okay. So if I forgo 1 or 2% in the cash flow, overall return is still more or less in the same ballpark, but it saves me any kind of aggravation tenants pay, and they are afraid to lose the lease. So that's sort of, but I'm also taking into consideration that they've been with me for a long time. I appreciate the loyalty, and I feel that it's a two-way street. I'm helping them with a little below the market rent, and they're helping me staying. If they leave and I have to turn their apartment sit vacant for 2 months, the answer to the question.
Yeah. So what about now? I mean, you say New York City has been an appreciating market. It's not right now. Is this a good time to buy? People have been asking me that. Is this a good time? Even Krista, our daughter, came up and said, "Why aren't you buying in New York? Prices are down." Is that true?
So it depends. Depends what type of investment and where. So I'm in Brooklyn, New York. This is where this market is much more affordable than Manhattan. Manhattan is a ghost town. People are, the inventory of oversupplied condos is obscene in Manhattan. A lot of empty condos. They've built through the roof. So the prices for condos for sale and the rental prices for apartments have gone down in Manhattan. Not here in Brooklyn where I'm at. For the reason that Manhattan demand came from office commuting. Again, people wanted to live near the proximity of their office. So now everybody's moving to suburbs. They don't have to commute. They don't need the convenience of Manhattan. Manhattan offered Broadway, parks, museums, the nightlife, all of it is shut down. So from that perspective, Manhattan prices are substantially, under pressure. While where I'm at is more residential neighborhood, and people live here, and they probably want to get away from Manhattan into here. So the demand here is still pretty good. We're not seeing any kind of substantial softness in let's just call them suburbs. So it's Manhattan to Brooklyn, Manhattan to Queens, Manhattan to New Jersey. All these kind of moves out is where people have gone to lesser density. As
Florida.
far as are there opportunities to buy? Potentially, if you have a long-term perspective and you can find a good location and you believe in the vaccine taking the full effect, the nightlife returning at some point, the city will reopen. Yeah, you may be able to find a discounted price. You have to know kind of what you're looking for. It's not a trivial play. It is an appreciation play if you can get the right price. You got to find motivated seller type of situation.
Makes sense. Yeah. Interesting. So do you think Manhattan's going to make a comeback at some point?
Yeah, for sure. I mean, think about it this way. Once the virus, I'm speculating, right? I don't have a crystal ball.
That's all we can do.
Well, actually, I like to put it this way. I used to have a crystal ball. It broke, and I can't find another one for sale. But looking kind of into the future, year from now, substantial portion of the population will be vaccinated. There will be herd immunity. So I think people will start coming back into the nightlife. So once that starts coming back, I think we'll get more population moving back in. Now, the office space, the fact that it's vacant and people are working on Zoom, there will be some level of a comeback. A lot of speculation, will people need more or less office space? Will they need social distancing, greater distance between the office? I think in aggregate number of people working from the office will come down somewhat. So the overall demand will be a little bit less. Because of telecommuting, I mean, this has been not a new trend. But at the same time, people will come back. There was something about commuting to Manhattan was a level of prestige. So I think the investing in office space is speculative. If you're a real estate investor, I don't know where the office space is going to go. Kind of the downtown, the midtown office may be in a depressed state for a long time. Residential, it feels like proximity to everything will entice people to come back. Now, the massive oversupply, it may take years to cycle through the inventory. That's just a separate conversation. But the general comeback is going to happen. Broadway will come back. We'll be living in a brave new world with some enhanced and increased telecommuting, Zoom-based and so on, and some return to kind of going to the office. Some people miss it. They actually want to go to the office. They wish they could. So maybe people will work 2 days from home, 3 days from home, a few days from the office, maybe shared space. Some other kind of optimization concepts will come back. But I think Broadway and just the general tourist coming to New York as a cultural, educational, social center of the United States.
Right.
I mean, there are other great cities, but I'm not trying to oversell New York. But it'll come back. So,
is that still your focus? Okay, so you went from the buying some apartments, and then you went up to then you got the multifamily. So let's continue on this path of your journey here.
So 2009, I kind of went full time into real estate as a fund manager. Okay. It was sort of coincidental, and it was also with a purpose.
Working for
But just
your own fund or someone else's?
so my good friend Joel Hoffman years ago started. He was a friend of many years, still a friend. Original Temple Funding, which was basically a fund that financed short sale flips. If you remember those days,
Yeah.
2009, a lot of inventory. Investors needed the capital to finance flips. So it
Yes.
was called transactional funding, flash funding, whatever word you want to use. So this is how we started. Joel actually called me, said, I started this company. I like the idea. I did a few short sale flips myself, and I financed a few. And he still wanted to retain a career in IT, and he continued his career. Just said, "Why don't you go run it?" What happened was that I was actually transitioning at that point, May 2009. I was done with my last technology company gig, and here comes Joel. Calls me, says, I was actually an investor, one of the original investors in Temple Funding. Says, I really don't want to do it full time, but I started the company. Could you join me and run the company and be a partner? And so,
Wow.
Just a small ask.
so I had an option at that point: go back and get a corporate job. And I was burned out. Honestly, there's nothing wrong with software. I love the field, but it's a very different. You had a lot of people reporting to me. It's at some point, I want to say 30, 40 people, many departments, some globally dispersed, ton of responsibility, not the lifestyle I really wanted to enjoy. So took a pay cut and kind of went into the real estate full time.
Wow.
So that was the starting point, how I jumped the ship, and I never looked back.
Courageous.
Yeah, the skills you learn from being a lender are so vital, so foundational, because it seems so simple. You're just lending money and maybe it's secured in first or second position, but you've got to underwrite those deals just like you would if you were buying it, right?
Yeah. So originally we did transactional funding, which was pure arbitrage. So we didn't fund transaction. They called it AB, BC flips, if you remember those transactions. So an investor would get a property under short sale under contract for say 300,000, and was able to market the property before they owned the property. So almost today like wholesaling.
Yeah.
They secured it a buyer for 350,000. So instead of doing a wholesaling flip on assignment, you couldn't do it. You
No,
couldn't
it
do
was
it in the past
illegal,
because
right?
it was not. Yeah, you needed a hard cash to close on A to B, and then close on B to C.
And then resell. Yep.
Yep. So we financed essentially initially A to B when B to C was irrevocably committed and fully funded. We just independently funded there. So it was a bridge loan for a day, 2 or 3 days.
Wow, that's a business.
It was velocity of money business. The money turned, and it was an interesting business, but it was short-lived because banks start putting in anti-flip restrictions in the short
Yep.
sale approvals. So it progressed. You have to hold it for 90 days. You have to hold it for 120 days. Okay, no problem. So we started to underwrite, and now we had to underwrite. It was more of a traditional hard money underwriting. What is the house worth? So if you're buying for 300, flipping for 350, yeah, we'll lend you, but 70% of the value of 350. So you got to bring some cash, called skin in the game, and a down payment. And the game kind of moved into classic hard money. Instead of a fix and flip, it was just a flip because fix was not necessary in a lot of these deals. And then it morphed from there into the fix and flip. You're buying a house, you're going to hold it for 90 days. Might as well do carpet and paint and get a little bit higher value. So we continued, and then we launched another fund, TF Investment Fund 2 in 2014, and then 2017, we at that point kind of continued to do a lot of hard money deals. But what came to me is we know a lot of people through the CG mastermind and other guys who were finding long-term equity deals, just great opportunities, and they wanted financing for long-term equity funding. So this is where we launched a next generation fund called Tampa Opportunity Fund in 2017 to invest in real estate opportunistically. The word opportunity comes from opportunistic investing. So we progressed and we launched that fund, no longer focused just on the hard money, but more of here's a good deal, and why it's a good deal. So real estate 101, real basic. Can we get this property at this great price, and what's the value add strategy? And it varies. I mean, it could be fixing up apartments, raising rents, or it could be conversion of an old Macy's to a self-storage. Really, strategy varied depending on the kind of asset class and the specialist, whoever we invested with. And as you know, CG had some great specialists, some guys in self-storage, some guys in multifamily, and so on. So it kind of morphed and progressed from there.
So what do you see as the opportunity? We're just about out of time, but we seem to possibly be presented with another opportunity now in 2021, maybe 2022. What will you be focusing on?
So yeah, it's a great question. And here is the greatest opportunity of the pandemic. I hate to say it, opportunity of the pandemic.
Yeah.
Pandemic has been a terrible thing for the world.
Sure.
Yeah.
But what it has done, it has differentiated kind of the winners and the losers. Unfortunately, there's distress created by pandemic, and the distress is pretty obvious. Hotels, right? So hotels are suffering, and it's unlikely they're going to come back very fast. And some hotels were damaged or not really functional pre-pandemic,
Mm-hmm.
and then the COVID put a cross on them, kind of knocked them out.
Mm.
So we've been investing pretty heavily in 2020 into hotel conversions to affordable multifamily housing.
Wow.
So as I mentioned, we have Tempo Opportunity Fund. We also launched beginning of the year, completely unrelated to COVID, but we planned it and we launched the Tempo Growth Fund. And that fund is heavily investing into the conversion, just one of the opportunities, conversion of hotels into affordable multifamily housing. Pretty basic concept. So I'll give you some real straightforward ideas. You take some old Residence Inn by Marriott. I call them high flag, but the hotel itself could be in a bad location. Not it could be a good residential, but people don't want to go there anymore. So it's
Mhm.
sitting there. It's a good candidate for conversion in a residential neighborhood. It's not necessarily downtown expensive hotel. It's kind of a B minus apartments, and you can convert to affordable housing. And there's a lot of sensitivity to that. So you could take Residence Inn example. They look like small apartments. I mean, if you've been into one.
Mhm.
They have kitchenettes installed. So conversion process is not super heavy lifting. You're not massively moving walls, but more of a, lipstick type of a,
Mhm.
and you could turn it into affordable apartments. If you could get it at the right price, you
Sure.
can execute conversion strategy. You can wind up with a pretty attractive financially project.
And it's so
So
needed now, affordable housing.
Right.
yeah, and you're doing good. You're doing good for the, I mean, I want to call it green investing. I don't know how else to put it, but you are essentially repositioning dysfunctional hotel into a affordable housing. Most politicians love the idea.
Mhm.
If you need some kind of additional entitlements or permits from the city, they generally welcome the concept. You still have to do work. You still have to make it look good, and you got to rent them out below average rent in that area because they're smaller apartments.
Mhm.
But there is a lot of demand for this. What's really interesting is we have one investment in Winston-Salem, North Carolina now. What's really fascinating is this. It's intended to be affordable housing development, but it's about a mile away from Wake Forest University. From what we heard, the university itself may be interested to get it for students. They're price sensitive. They want affordable housing.
Yeah.
Yeah.
Nice.
Wow.
So
Nice.
Good
And so it
stuff.
seems like looking forward, you're kind of an opportunist. You just kind of look for what's working and what fits the model and then adapt to that. That's what it sounds like.
yeah, I mean I'm not a Wall Street guy. I'm not a professional Wall Street investor. I'm more of a Main Street investor.
Yeah.
But the Wall Street uses the word allocator. So my job is to allocate capital in the best opportunity. So we shift with the market. We're not trying to be a specialist. My job is to find greatest people on the planet, the best and smartest operators who in the best strategy. So we always start with people. If they are high integrity, high experience, capable operators, we start working with them. We start looking what is their strategy and what their next investment looks like. We start with people, the strategy, and then we decide how much capital to allocate. We watch. I mean, as a fund manager, what's the job number one? Diversification. I got to make sure we don't overload into anything. Even the
Mm.
best strategy that looks most attractive today, if you write too many checks in that field, you could wind up with overloaded portfolio. COVID taught us one thing: diversification works. If you were
Yeah.
well diversified, you absorb the hit. And if you were focused on hospitality or some enclosed malls, you took it on the chin in a way that you can't recover.
Yeah.
So I'm going to ask a kind of broader question based on your background, which is fascinating. I think growing up in Russia, there was maybe not a lot of respect for private property rights. Would that be correct?
There was no private property.
There's no
Mhm.
private property.
There was, at least I grew up during socialism. You live in a government apartment. You go to work for the government. There was no
Wow.
private property.
So, what should Americans pay attention to? There's these conversations about, are we becoming a socialist country? Are we moving towards communism? What do you think people should pay attention to make sure that that would not happen in the way that um, that you experienced?
So I have obviously a set views and values, and having immigrated, I can tell you that socialism and communism just don't work. Now, there's some certain concepts, social concepts or socialism concepts that may be reasonable and applicable, but you got to watch out not to dive too deeply in them. So
Mhm.
taking care of the elder and sick, and it makes a lot of sense,
Sure.
but you have to be really careful to give too much power to the bureaucrats. That's one of the major concerns. Bigger government bureaucrats in charge. It breeds nothing but corruption,
Mhm.
massive corruption. Whoever is in charge of whatever it is, they find ways to corrupt, steal the money. The government money goes to waste. So that's one of the major risks and concerns of a big government, and will do good for the people, will create all these programs.
Mm.
People in charge find a way to corrupt, they become corrupt, they steal. There's just no way to explain it. In a private enterprise, the owner is in charge. With the government, who is their boss? It's another boss in the system. So it becomes they grease they call it, they grease the roof. That's one of the expressions in the former Soviet Union. You got to have a roof. Roof means the people who put you in that position, you grease them up. In order for you to be successful, you start milking the system and take bribes, or I'm going to crack this joke. It's a
Mm.
true story. So I went to my orthodontist. I hope he's not going to get. I'm not going to get in trouble. Yesterday, not me, for my phone, for my daughter yesterday, and he got a vaccine shot yesterday for the new vaccine. And I asked myself a question: is he a frontline? He's a great guy, by the way, but is he a frontline worker who should get vaccinated first? Well, the answer is he's well connected. Well, that's the answer. The
Mhm.
government is in charge of the distribution of vaccine. So the decision process, bureaucrats in charge start making decisions. They start giving it to their friends, family, relatives. And when the system is based on somebody making a decision by a bureaucrat, they will make the decisions that'll benefit their friends and family first. So one of the major risks of socialism is bureaucrats in charge get more power, more wealth, and it just doesn't work. That's just got to be really careful. Now, what I do like is certain elements of when they grew up in the former Soviet Union, they had a great university system, and it was free.
Mm.
Still, there were a lot of corruptions to get in, and you had to bribe people. But the idea is great: free education, if the government pays for it, and it can be maintained some kind of free of bribery, and
Right.
and you know, then so education is good. Now, medicine, I have to say this: there's a lot of theories about Medicare for all, and having the government essentially ration medical care. A lot of risk, because I saw that in the former Soviet Union. Yeah,
Mhm.
you get the bed in the hospital, but if you want attention, you got to bribe the doctor. So the moment you start putting bureaucrats in charge, they find a way to enrich themselves. And I'm not saying is anything wrong. It's a human nature, unfortunately. So private insurance, private enterprise in general is better than the government rent program. So
Fascinating. I
that's,
mean, we saw it just in our HOAs that we've been involved in, where the people who are on the board of the HOA would hire themselves or their friends and overpay. And, it's even on the smallest level, it can happen. So, of course, if it gets bigger and bigger and bigger, you might expect the same.
Yeah, whether it's socialism or fascism, right?
Yeah,
It goes
whichever it
either
is.
way. It's
Yeah.
the higher ups who spin things in their direction, to benefit themselves. That's the big
yeah,
game.
I don't think we have a major risk of socialism in the United States, but we're moving into wrong direction. So I don't want to scare people. There's some great ideas, but it's almost like um, the promised. It's a myth. It's a utopia. They promise you great results. We're going to do all these good things. It's the road to hell is paved with great intentions.
Yeah.
So the intentions are good, but the problems in the execution just kill the best ideas possible. So
Yeah,
Awesome.
great.
Thanks for that.
Oh,
Thanks for that.
well, it's just incredible insight. Thank you so much for sharing your history and your tips with us on The Real Wealth Show.
you're very welcome.
And thank you so much for joining us here on The Real Wealth Show. We'll have more real wealth stories coming with Rich Fettke here as my co-host.
Yeah. Woo.
Yeah, so you can check those out at realwealthshow.com.